It's simple math, right? If you're going to pull $5,000 a month from your account, maybe you're getting Social Security, maybe you're getting a pension, maybe you're still working part-time, whatever. If you're going to pull that $5,000 a month, that's $60,000 a year times 5 years is $300,000 at a bare minimum, not in the stock market. That's getting into capacity, and that's getting in actually to the simplicity of it. Like, it doesn't need to be more complicated.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Jake, thank you for having me back.
Cory, last episode, you got to listen to me rant about travel.
That's right.
And my dislike for it.
How could we forget?
And my dislike for it. This week, we were just getting ready to record, and I asked you about your hair because your hair, we both changed our hairstyles.
What do you think? Okay. Yeah.
And I want to talk about your hair, and then we'll talk about my hair. What are we doing? Why are we doing this? We didn't talk about this before. But we're both
when you say this, how do you describe that, Jake? So I know what you're talking about.
We're both changing our hairstyles. Why are we doing this?
Okay.
Why are we doing that?
Oh, okay. Got it. All right. I thought you meant literally my hairstyle. So you want me to start?
Yeah, yours is very different.
I've been trying to grow my hair out. Basically, I have the gal that cuts my hair, who has for a long time now. I've told her my goal is to try to grow my hair as long as I can without it looking ridiculous. Now,
okay.
In my own mind, you might say, Cory, it already looks ridiculous. You've already reached that point. And I can live with that.
No, you're just in the in-between stage then. That makes sense.
I'm in the in-between. That's right.
I'm very lucky. My hair grows fast.
Yep.
And I got a lot
of it.
I'm
even using I'll reveal this. This is a confession. I even have a shampoo and conditioner and hair serum regime that I go through every other day that I'm coming up on 2 years now of doing.
Good for you, Cory. Hey, maybe that's
I'm trying to keep this hair on my head, man.
Enhancing our clients' lives. There you go. Well, mine, I might switch up again. It's looking too round. I want it to look more square. So I'm going to talk to. So stay tuned for those watching Upticks. Maybe our hairstyles will change. But Cory, that's not the point of the show. So let's get into today's topic. I did want to talk about it, but a quick thank you to our audience. Our subscriber count continues to grow on YouTube and on the podcast platform. So thank you. Again, the whole point of Upticks is to enhance financial literacy. So if you have any topic suggestions, please email our producer, Luke at falconwealthadvisors.com. And Luke will make sure that we talk about your topic live here on Upticks. Also, me and Cory are very active on social media. So if you want more great content from both of us, you can follow me on Instagram at Jake_Falcon_CRPC. And Cory is Cory Bittner KC. So again, follow us on Instagram. And if you want a copy of my ebook, all you got to do is follow either of us on Instagram and message us RR. And I'll send you, me or Cory will send you a complimentary copy of Retiring Right, Smart Steps for Exiting Corporate America. It's the PDF version, 150 action-packed pages on retirement planning. All right, Cory, you ready to get into today's topic?
Let's do it.
All right, let's play ball here. So today's topic, Cory, is simple ways to invest your money after retirement. I'll let you kick us off since you're my guest.
All right, let's do it. So as far as investing in retirement goes, I think that it does not need to be as complicated as people think. The approach that we take, Jake, for our clients, and what I think the right approach is really to think about your risk tolerance, your risk need, your capacity for risk, and then ultimately using an investment portfolio to fund a financial plan that you have established.
Yeah, good. So yeah, you're talking about alignment here. I also want to talk about maybe quickly some things not to do because yes, we don't want to overcomplicate it. We don't want to use products and get heavy on that. But I think some people have this misconception, Cory, and this is a real thought, and I'm not discounting this thought, is that some people will say, hey, Jake, my 401k has been averaging 7% a year. Why would I hire you to manage it? And And I'll tell you why. This isn't a
Please.
plug for me, but I'll tell you why it's important, because when you're accumulating wealth, market volatility doesn't really matter nearly as much as when you're distributing or spending that wealth.
Yep.
And so I don't want you to oversimplify it and just leave it in your 401k or in a target date fund and think that that's going to be okay. So I like your point, like overarching. Let's not overcomplicate this. Let's literally just get your investments aligned with your plan. And I know you and I are going to go into more detail. But the quick point I wanted to make, Cory, is like, let's talk about some don'ts. And don't think just because you've done well in your 401k that it's going to keep doing well, because that's not how investing works. Do you have any other thoughts on the don'ts?
I do actually. Don't make investment decisions either based upon what other people are around you are doing. I think that's
Good.
crucial, particularly when we're talking about investing in retirement. Along with don't assume that your asset allocation should be based on your age or even retirement. Your asset allocation should be based upon your actual need for the money and when it's going to be spent, whether or not you're working.
Yeah, we're making this sound a lot more complicated than it is, and maybe that
You're
was the
right.
point of the topic.
Given how I started the show, right? Yeah.
Yeah, given the topic, but I do, again. Please stay tuned, because I've got some simple suggestions here for our
Yes.
audience. But that's good. Yes, I love that, Cory. Don't compare it with your coworker or your brother or your sister or your neighbor. It's got to be specific to your financial plan. And then again, don't use these cookie cutter products. In my opinion, a retiree has more of a need for customization than a pre-retiree.
That's
And
right. That's
and
right.
customization, though, does not imply complication. It's just saying that it
I
needs
like
to
it.
be aligned, because you've got to be able to, this is the key point we're getting at here, is you've got to be able to know what is going to fund your month to month spending and where that money's coming from. And that's so important, is that we're looking to replace a paycheck here. We're not just trying to make you the most amount of money. We're really switching that return objective. You still have a return objective, but what's equally important is cash flow and income. And if you need to replace $10,000 a month from your salary, then
Yep.
we need to darn well make sure that your portfolio can do that, even in markets like we're experiencing right now. Because if you just have all your money in some cookie cutter index fund right now, Cory, and the market's pulled back 4 or 5%, whatever it's doing, that's a problem. That's a big problem.
Right. Yeah. And that's so humor me this, Jake. You've probably heard this one before. I know that I have, and I completely get it. But you've probably heard this, Jake, where someone would say, you know what? I'm retired. I'm close to retirement. I can't afford a massive market drop.
Oh, yeah. I hear that all the
So
time.
if you've had this thought, a question to ask yourself is that statement based on an objective risk capacity or subjective risk tolerance?
Those are two different things.
Two very different things. Your risk capacity and your risk tolerance are not the same thing.
Good,
Your
Cory.
risk capacity comes down to your situation. Your tolerance is more subjective. And that's okay to acknowledge that,
I
like, your
love
risk,
that. That's a good
because I think
one.
that people, Jake, I've joked about this, that people describe themselves as bullish or aggressive investors when the markets are doing well, and they describe themselves as conservative investors when the market's doing poorly. That's very subjective, but that's very different from your objective actual risk capacity in your portfolio and financial plan.
Yeah, that's good. I got a couple quick tangents for you.
All right, perfect. Are
So
they
one,
about
Cory,
travel for my hair?
no, not about here.
All
This is
right,
about
okay. All
this.
right, let's hear 'em.
Not investing and planning. So when I was
Even
early
better.
in my career, so I started in this industry in 2006. So right before the housing bubble burst, and I got a lot of new clients, some clients that are still clients today, obviously,
Mhm.
in 2007 and 2008. Cory, and I would argue when we were initially establishing their financial plans, their risk tolerance was far lower than clients that I met with during a bull market. So you're absolutely right that risk tolerance, I think, is impacted by current market situations, right? Or where the market is. So I want our audience to know that a good advisor should take your risk tolerance into consideration. However, that shouldn't be their sole
Mm.
determinant of their advice for you. A good advisor would say, okay, Mr. and Mrs. Client, I hear your emotional piece, but like you said, what risk capacity should be married with that risk tolerance. And that to me is a well-constructed financial plan. If a client comes in here, Cory, and they say, I don't want any stocks at all, and they're 55 years old, the first thing I go to is I say, can their financial plan support them not having any stocks? So I said, I hear you, and I want to, and I usually dig deeper. I'm like,
Yes.
why don't you like stocks? Has there been an event in your life that's caused that? Have you made a mistake? Has another advisor screwed up something? Like, I want to get deeper, so
Yep.
I will peel that onion back. But when I'm actually doing the technical work, or my planners are, I tell them that, like, look, we need to take their tolerance into consideration, but I want to see their capacity for risk. Because that's good. Because some client, they may have enough money, Cory, where they can be all in bonds, and that makes enough interest where they don't need to own stocks. And you know what? That I'm okay with that, actually.
That's right. Because if that is a plan and a strategy that you can stick to, and that's the key, right? You've got to stick to it. That is the most important part. And that's again where the capacity and the tolerance, it's good to kind of marry all of those things together. But
Yeah, let's go ahead.
no, I just wanted to quickly make the point though, because we are recording this episode about simple ways to invest in retirement. I just want to make the point, Jake, that especially right now, there's market volatility. We've all seen it. There's concerns that people have, but that does not mean that you need to pivot your entire retirement strategy to gold or some expensive insurance product or an annuity or whatever else. It is not that complicated. And
Right.
there is fear mongering out there. There's concern out there. And I'm just a part of, Jake, there's a Facebook group that you and I have both been a part of with a lot of retired folks that are in it. It's not something that you and I have. But I find it interesting to see just some of the sort of crazy ideas that people come up with, particularly when the markets get volatile. Let's not make it more complicated than it needs to be.
Yes. Yeah. And that's good, Cory. And again, this show is not advice. However,
Yes.
as a general statement, you shouldn't be using market fluctuations to adjust your strategy. Your financial plan and investment strategy should be built knowing you're going to have good and bad markets. But it's too late to adjust
Yes.
when the market goes down. You should have thought of that before. And the good news is, for our clients, we do think of that before. When we're building
Exactly.
a portfolio, we think about bad markets believe it or not, we're thinking about that. But I wanted to get deeper into your capacity point,
Good.
because that is the simple part, actually, is capacity. So for our client, and again, this is general, every client situation is going to be a little bit different. So if you want to talk more about your situation, please reach out to us. Let's schedule a meeting. If you're not a client, we'll build a plan. If you are a client, we'll review your plan. But the idea is, generally speaking, at a bare minimum, Cory, we want to have at least 5 years worth of retirement spending not in the stock market, and ideally 10, but a minimum 5. So it's simple math, right? If you're going to pull $5,000 a month from your account, maybe you're getting Social Security, maybe you're getting a pension, maybe you're still working part-time, whatever. If you're going to pull that $5,000 a month, that's $60,000 a year times 5 years is $300,000 at a bare minimum, not in the stock market. That's what we're talking about when we talk about risk capacity.
Yep.
So if you only have $500,000 in this scenario, then the argument, well, first off, we got to see if the plan will work over the next 30 years to begin with.
Right.
But from just an investment, we're talking about investing today, just from an investment standpoint, then you can only have 200,000 in stocks. I would not recommend that person have more than 200,000 in stocks in this example. But again, I don't even know if that financial plan would work to begin with, but I'm just giving you a generic example. So again, that's a minimum, ideally 10 years. So in this example, ideally you have $600,000 not in the stock market and not in annuities either. We're talking about bonds and cash, money market, so that you can weather market volatility. And then that capacity, let's say in this example that you have $1 million. So we say,
Yep.
okay, we'll put 600,000 Cory in bonds and we'll put 400,000 in stocks. And then we will rebalance accordingly as the market shifts and as your plan shifts and as your spending happens. But that's getting into capacity, and that's getting in actually to the simplicity of it. Like, it doesn't need to be
Good.
more complicated. You need to know how much we need to know this so we can give you advice, how much you're going to pull, right? And how much you have. And then we can start to back into how to simply invest for retirement.
Yeah, that's good. Jake, I read that. Yeah, I'm glad that you kind of put that way, because the simple way to invest is to really align with the actual money with when you're going to spend it. And I've read somebody who's put it this way, where they said, effectively give your money an anticipated use by date before you're actually implementing any big investment decisions. And to just piggyback a little bit off of what you just stated, Jake, I had a meeting with a client yesterday. Plan has been to retire in 2 years from now. This has been the plan all along. But he said, you know what? What does it look like if I retire this year instead of waiting 2 more years? And we drilled down into the cash flow. We drilled down into what it is that they actually need. We drilled down into their portfolio to look at their risk capacity. And frankly, I think that it really helped this person get their mind around walking away from employment and entering into retirement. And they're in a situation to do it, knowing that the next 10 years of money that they're actually going to pull out of their accounts here is not invested in the market in the first place.
That's fantastic. That's perfect.
So the
That's
idea there
textbook.
is we see what the market does on a day-to-day basis, but if you're not going to touch that money for 10 years, it shouldn't affect or impact your ability to retire in the short term, as long as it's invested properly and you have a plan in place.
Right. Right. Now, this is one way to simply do it, and probably the most common way that we start with our clients. I have another one that I was actually speaking with a potential new client yesterday about, Corey. And
Okay.
a perfect, not perfect, because there is no perfect, right? I shouldn't say that. But a ideal situation, though, would be to build up the portfolio enough and invest it in stocks and bonds. And the income from dividends and the interest from bonds covers the cash flow.
Mm.
I have clients that have that set up also.
Yep.
And so the allocation, yes, we still want to make sure they have at least 5 years worth of income in bonds or not in stocks. But ideally, in this situation or this example I was using earlier, like $5,000 a month, the 60,000 a year, if we can build a portfolio that generates 60,000 a year in dividends and interest, what the principal does day to day, month to month, year to year, decade to decade doesn't matter, because this client knows, in this example, that they're not touching principal. They're living only off interest. Now, not everyone can do that. It just all depends on how much money you have and how much you're spending.
That's it.
But that's an ideal one. So those would be that's a simple way. I mean, and again, if you want to go that route, you also have to be willing to lower your spending.
Mm.
Right? So let's say
Yep.
your portfolio only generates 4,000 a month. And you say, "Jake, I never want to touch my principals." Like, okay, well then 4,000 a month is what we can realistically do for you. There is no guarantee, but this is the projection, and that's how we go down that road together. So that's another concept to this. Is like, and I think I talked about this, didn't I, last
Mhm.
week maybe, that like you can always adjust your spending. You can. You
That's
can
right. You
always
did talk about that last week.
you can always adjust your spending. So again, people are very quick to blame the market when you have market
Mm.
pullbacks or poor
Sure.
performance. But there's two sides to that coin. If you're really worried about it, just cut your spending,
Right.
right? Cut
It's not
back on
very
your spending.
attractive, though.
People don't want to do that ever.
We're a consumer economy, man. We love to spend money.
Yeah, the consumer economy is important, Corey, from a macroeconomic. We need a consumer economy in order for the market to continue to go up. We need people consuming goods and services. So I understand that. But
Yep.
you also have to
But
be
I'm
the
with you.
adult here. You have to be the adult. And if your portfolio isn't enough to generate to accommodate your lifestyle, then you have to understand you either need to go back to work or you need to cut your spending.
Right. Yeah. And if you bury your head in the sand, there's going to be a rude awakening at some point in the future.
Yes. And we want to avoid that. We want to shed some light on that and not let that happen. Now, again, the vehicles can vary. We are very simple. Like, we want to keep it very transparent and very clean. So at Falcon Wealth Advisors, we believe in owning individual stocks and bonds. We believe in that wholeheartedly. There are if you're a do-it-yourselfer, though, is my point. Let's say you're
Mm.
watching or listening to Upticks right now and you want to do it on your own. If you're not going to watch the stock market every day, then I don't think you should be in stocks. I just don't. Corey, we have 4 people. We have 4 people on our team that do this full time.
Right. And for what it's worth, a guilty confession that I have, Jake, is I've stared at the market every day for 15 years now. We have full-time investment professionals, but you and I, right? We watch the market every single day and we know what's going on.
I do watch it every day, but you know what? I still don't have the capacity because I'm
Correct.
meeting with clients.
Which is actually my point. Like,
Right.
despite that, you and
And I'm
my
licensed.
retirement accounts are invested in our portfolio that our investment management team handles.
Right. Like we've given them the rules, like the parameters, but then they
Yes.
go and watch it every day and monitor. So if you are do it yourself and you're not going to do it, the alternative is you could look at index funds or mutual funds. Even annuity. Again, I just think all of those three products sold by advisors are bad. I think if you're going to go do it on your own and you want to kind of set it and forget it, then you probably do need a product, but you're going to have to go do some research and understand the fees and the risks and all that stuff, the underlying investments. You need to do your homework, of course. You can't just slap it in something and think it's going to be fine. You got to understand exactly what you own and why you're buying it. That's why people hire us, Corey, is so that they don't have to do that work and they don't have to monitor it every day. But again,
Mm,
I think advisors sold products are actually overcomplicating things. And that's why I think that's a good topic for today's show is that the simplest way is to buy stocks and bonds. It's just the problem why you can't do it on your own is that you have to be watching it every day.
that's right.
And not only do you have to be watching it, you have to be willing to make an unemotional math-based decision. And not everybody can do. Not most people can't, I would argue.
That's the hardest part,
Yes.
I think.
And our team, we obviously care about our clients very deeply, but our investment management group, they're trying to remove emotion. I mean, they're humans, so there is some emotion there, but they are attempting to remove emotion and they're using math to base their decisions. That's it. When we rebalance for a client, it's a mathematical equation for them. It's not well, I'm going to go on vacation soon or what's the market going to do tomorrow? It's no, the client's out of balance. We got to rebalance it. That's what they're doing. Or we got to
Yep.
trim this stock or we got to buy this bond. Like it's all math for them.
Yeah, I agree completely. I think though, Jake, just as we're talking this through, if somebody out there was doing it themselves in retirement, we've talked about the 60-40 portfolio. Obviously, you need to understand what your cash flow is, and that's the primary driver. But that kind of has been not a gold standard, but a standard that a lot of people have looked at for a long time, right? 60% equities, 40% bonds, kind of like the 4% rule, painting with a very broad brush here. So it's not investment advice. But my point is, for an individual to invest their money for retirement 60-40 using a handful of funds is very simple to do, and it's very cost effective to do. You don't need to overcomplicate it. Again, our clients hire us because we're actually going and picking the investments. We are eliminating the best that we can, the emotion from the equation, doing the financial planning and the tax planning. But my point is, if somebody did want to do it themselves, and if they were going to rebalance when they needed to, it's not as if it's a terribly expensive or complicated endeavor to set up what we're talking about.
Right. But in that 60-40, you got to make sure that 40 covers at least 5 to 10 years worth of
And that's why I say
distributions.
I'm painting with a broad brush here, but yes, like I'm talking about actually investing the money to accomplish that. If that's
Right.
the way that it all works out for you, not terribly difficult, not terribly expensive.
Right.
But there's a lot involved, and most of our clients don't want to mess with it in retirement. They don't want to have to worry about what the market's doing day to day, or rebalancing at the right time, or figuring out their tax planning. That's why they've hired professionals to help them and to support them.
Yes. And I would argue that's a sense of wisdom, also is that like they aren't overconfident thinking that they
Mm,
know everything. Like just
that's
like
right.
me, like I don't go and try to like claim that I can fix my car.
Right. You
I
can pay
can't.
for the answer, right? You can pay for somebody to fix it.
Yes, to do it the right way that does it full time in there. And that, and be a trusted guide along the way. And that's again, this show is not about a commercial for us today, but like you're right. You can simply do this on your own. Our
Yes.
argument is that it does require attention. It is a full-time job. And like I have a client told me before, like his mistakes that he makes on his own have multiple zeros behind them, and he doesn't
Mm.
want to make that mistake. In fact, he would rather blame me, which good for
I
him,
bet he
right?
would. Yeah. Right.
Blame us. Like that's fine. That's what we're here for. Like we're going to make the educated decisions on the investments and we're going to do the planning work. But if something doesn't go right or there was a decision that didn't work out, blame us. That's easier than blaming yourself, like and putting that pressure on yourself. Like most of our clients, they're smart people. They just are in
Yes.
different professions. Like again, I'm not a dentist.
Right.
I go to my dentist to make sure my teeth are right. You know,
Right. We're not
let's
coding
bring it back.
software either.
I'm not a barber.
That's right.
I go
That's
to
right.
my stylist and say, "Hey, make it look good. I trust you."
Need to tell them, make it look more square, less round.
I think it looks. Do you think it looks too round?
No, I don't think so. I think I see your point though.
I think heads are supposed to be round, is the argument, but like The other
That's true.
the other deal is it just grows out so quickly. I probably just need to
Yeah.
go see her more often is what I need to do.
I tell you though, man, the older that you get and me, it's not a bad thing. Let that hair keep growing.
Yeah. So
Let it
it
keep
doesn't
growing.
bother me. Rachel likes it, but she also says do whatever I want. So maybe I'll just shave it off, Corey.
Ooh, that I would like to see.
So
I don't know if you should do that, but you know what? It's
no,
your
I
life.
don't want to do that. I don't do that. All right, good. Do you have anything else to add as we wrap up on simply investing for retirement? I think it's a good topic, very
Yeah, I
popular
think so
topic.
too. It's the actual investing piece, exactly like you said, Jake, to wrap this up. The capacity is the simple part. The implementation, the monitoring, the adjustments, that's the more challenging part. But the figuring out some of the core details is not terribly complicated, and aligning an investment portfolio with that too. But you've got to manage it and monitor it along the way.
Right. And I love that you said, like, don't let your tolerance influence your capacity. You got to understand both. And then
Yeah.
it actually is really simple. Like,
Yes.
literally, you and I have had thousands of meetings about this. I talk about this all the time. So when I meet with a potential new client, I gauge their tolerance, and then I look at the data for their capacity, and then boom, we build the plan. And that's one of my favorite meetings, right? Because I get to know. First of all, I like meeting new people, but I get to know their situation, and then I figure out how are we going to marry this person's tolerance and their capacity, and build them a plan that works. And
Yes.
then I kick it to my financial planners who do a great job of crunching all those numbers. They know my rules and my policy. They build the plan, they deliver the plan, and then they monitor that plan with the clients. But that's the key. It really is that simple. Tolerance, capacity, move it together, build a portfolio, and then like you said, it requires ongoing management, monitoring, and adjustments because again, what you define for your financial goals in your plan today more than likely is going to be different 10 years from now. And you
That's
know
right.
what? That's when we adjust that allocation, though, is when your plan and your goals change. We don't adjust the allocation when the market shifts. We adjust during market shifts, pullbacks, run ups, whatever, we're rebalancing back to your target. That's what we're doing. But when we won't change your target or your allocation unless your plan changes, that's when we need to adjust it.
Which is a whole lot different than putting all your money in stocks when the market's doing well and taking all of your money out of stocks when it's not. Very, very different.
Right. In my opinion, the best thing you could do during market volatility is just make sure your account is balanced according to your
Yes.
plan. That's it. That's all you need to do, believe it or not.
Yeah, we've talked, Jake, on the show before. Carl Richards is an author, and he's the one, the sketch guy that has, and there's one that I saw recently that he shared, Jake, that showed basically just two axes, and it was activity and investment performance. And it was basically just a simple and elegant way to say the more activity that you are taking, oftentimes the more that can actually hurt your performance
Yeah.
when you're constantly trying to change things as a byproduct of what's happening in the market.
Right. Right. Now, again, we aren't buy and hold. We
Of
do
course.
believe that you do need to rebalance and buy and sell. But you're right. People get in there and fidget with it all the time. These day traders, it's all BS. They're not making money. Again, and if they were making money, they wouldn't be selling you on how to do it.
Yeah,
They
that's
wouldn't
true.
need to. So again, day trading, over analyzing, over manipulating, over trading. We don't charge commissions, but places might. So that's what they're
Right.
getting at too. Like if you overtrade your account somewhere, you might be dinging fees on yourself and not even know it. So again, there's a fine line there. You don't want to be just buy and hold, do nothing, but you also don't want to over manage it. So I think there's a
It's kind of like
sweet.
you don't want to overreact or underreact to anything.
Yeah. Keep it aligned. Keep it aligned with your financial plan. Make sure you've got your short-term cash flow not in stocks. 5 years minimum, 10 years ideally, 5 years minimum. And then let's blend it, let's diversify it, and let's monitor it. And that's really what it boils down to. And that's great. That's a great topic for today's show. And I want to thank you
If
for
I
talking
may,
with me.
Jake, I'll be
Yes.
brief here. I know we're bumping up at the end. I just want to share a really quick story about blind spots. That's aligned with what we're talking about. I have a client
Okay.
that I work with. I met with for the first time 10 years ago, which is kind of crazy to think about. But he reminds me of this to this day. That in our first meeting that you were talking about earlier, how they described themselves as conservative, the approach that they took, it all made sense. But I looked at the 401k statement, and I remember looking at him and saying, "This isn't conservative at all." And he's like, "You know what? You're right." And this was his retirement, getting ready to go. Here's a big chunk of the money that I've got. conservative, don't like taking too much risk. I look at the statement, I was like, there's a lot of risk here. We've helped him get adjusted, but he has reminded me to this day, Jake, that he's like, I told you, Cory, that we were conservative, but you pointed at my investments and said, no, you're not.
That's good. That's good. People, you're right. People don't always have that aligned. And so you got to understand what you're doing. Or I've had it where we've been conservative here with the account, but they have been aggressive in their 401ks. And so now they think, well, my 401k is doing better. I was like, well,
Yeah.
it's only doing better because we've been in a bull market and you've been more aggressive, and we knew that. Like,
Yep.
you can't compare. You shouldn't compare your performance that way. It all should be aligned with your financial plan. And so if
That's right.
you're aggressive over here, but you're conservative over here, you need to blend the two and then figure out what's going on. So
Excellent.
that's good. That's good. It's just awareness. That's all you did, is you brought awareness, which is very important.
Yes. Thank you.
Good.
I just wanted to share
Thank
that because that's a very real example that still sticks in my mind from a decade ago.
That's a good one. Thank you for sharing that, Cory. And thank you for joining me this week. And thank you all for tuning into Upticks. Please like and share our content. And we hope you have a great rest of your week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.